Hi, this is James Zhang with Full Capital, and today we are doing a multifamily financing update, and a ton of data has really come out. So I wanted to touch on that, talk about multifamily loans and sort of what I'm seeing in the market, and then as you guys have questions, definitely put it in the chat, and I will address those at the end. So um, let me put everybody on mute first. I guess that would be number one. Hold on one second, guys. All right, here we go. All right, so you know, my background is born and raised in Houston. Went to school at UT and UT in Austin. Have been an underwriter for about 8 years at GE Capital, and then the last 5 years, I've really focused on originating multifamily loans, and then I also invest as a limited partner across. I've done about 30 transactions. About 8 or 9 of those have sold in the last 2 or 3 years. And so I'm in about 20, 21 properties right now in DFW, Austin, and San Antonio. So this is where I wanted to start is the overall theme is it's all relative. We're going to start with GDP, talk about jobs, talk about sales volume, pricing, rents. And then a lot of people are saying, this is really a K-shaped recovery and how that affects jobs, markets, and rents. So starting with GDP, you can see this is the last, let's say, 8 years or so. We had a big negative in Q2 after a small negative in Q1. So 2 negative quarters of GDP, that's, the official recession. And then, Q3 was a big jump back. And so, everybody was expecting in Q3. Nobody really knows what Q4 has in store. So Moody's, if you look in the bottom left, they have their baseline case right here for Q4. And then, if we have a longer recession or protracted slump, it's even worse. And how that sort of carries over nationwide for multifamily, if you look in the bottom right, almost everybody's predicting higher vacancy this year in 2020, and then negative rent growth for 2020. And also a negative rent growth. This is on a national basis, negative rent growth for 2021, and then come back positive in 2022, 23, 24 on a national basis. So, when you talk about GDP, you talk about your big hits, the first thing that comes up is really jobs. And, in terms of the number of people who have filed, it was very quick in this recession compared to just sort of like a steady burn like we've seen in the past. And I thought this was a more interesting way to look at unemployment is that the unemployment is sort of the top line number that's reported in the news. But there's actually 6 levels of unemployment. So Ken McElroy actually does a great job. If you Google Ken McElroy unemployment rate, he did a video recently sort of going from, I think it's U1 all the way to U6. And U6 is everybody. So if you look on the bottom, unemployed plus marginally attached plus part-time for economic reasons. So that includes everybody. And so there's a gap of about, let's say, 5% between the reported unemployment rate, which is even lower now, compared to that U6 rate. And so I think there's a little bit underreporting compared to where we were at the 3% previous to COVID. And in terms of unemployment, though, it's not evenly spread, right? So if you start on the left-hand side, the unemployment of some of these states, Hawaii, Nevada, California, Rhode Island, New York, are almost 10% or higher, right? But then as you get into some of these not as tourist and hospitality dependent, a lot of these are right back, down to where they were before, maybe a little bit higher, but have not been dramatically hit. And within those markets, though, if you guys have kids on this left hand slide, if in terms of staying in school, the green line right here is the people with bachelor's degree or higher. They had about a 5% dip in employment in February, and then it came back all the way back to pretty much normal now. But then people with some college, high school grads, and in no college, those people are the job market that has been hit the most in this recovery. So, and then in terms of wages, very similar. if you're getting paid sort of over, let's say $28 an hour, your wages have come back. And then, but the people who are making under 16 an hour, those people are about 20% down still. Um, and then, so, in terms of how this is impacting, how COVID has impacted gateway markets, and gateway markets are really what you think of the coastal cities, the San Francisco's, LA's, New York, Chicago. Um, those markets, they really call them like the top 6 markets, and where people are moving to is away from those markets. And sometimes it is not like, I lived in New York, now I'm coming all the way to Texas. A lot of times I used to live in Manhattan and I'm going to Connecticut or New Jersey. Same thing in California, right? These people are not necessarily leaving California. They just might be moving 30 minutes to an hour, hour and a half away from the city for cheaper rent and just a little bit more space and not as dense. And so I think it's a combination of two things right there on the migration patterns. And then when you start looking across what has sold, and this is the sales volume of multifamily nationwide. So you can see in 2018, 2019, we trade about 35 billion or so, and then it go up to 49 and 54. But you can see that in Q3 last year, we did about 49 billion in the US, and then it dropped to 24 billion. So about cut in half year over year. Q2 was even worse, 46 to 15. And Q1 was about the same. So most people, Q4, there's probably going to be a similar decline in volume. So we'll probably be right in that sort of 2013, 2014 volume, total volume, but it wasn't nearly as bad as 2009, 2010, 2011 in terms of volume. And that really is because of the financing that has sat and been in the market, and collections have held up. So the combination of those two things. But I thought this was super interesting is like, all right, where the national volume is down, the overall volume in some of these markets is not down as much as we would think. So New York is still sort of your top market in terms of transactions and dollar amount. But I think that year over year is down significantly, whereas a lot of the capital has shifted down to the Atlantas, the DFWs of the world, Austin, Houston, those areas, Phoenix. So people are sort of moving their investment dollars on top of themselves to some of these secondary markets, not the gateway market. So here they listed the major markets that they track. This is Yardi, or this one was actually came out of Newmark. So Boston, Chicago, LA, New York, San Francisco, Washington, DC. That's what they considered major markets. And so the question always is, why are people still buying? Why are people still interested in multifamily? It's really this yield spread, right? So if you look at cap rates overall, about 5%. 10-year treasury has ticked up a little bit here recently, but 70 to 80 basis points in that range. So your spread is still 468. So when was the last time the spread was that wide? You're really 2009, 2012, 2013, that spread was that wide. I can't remember this, but a year and a half, 2 years ago, the spread got down into this 250 basis point, was probably the lowest until rates started coming down again. And so a combination of the migration, combination of what areas have been hit the hardest in terms of densification, in terms of leisure, hospitality, New York, Las Vegas, Orlando, you can see the rent collections in these markets year over year. New York's down 5%, same with Vegas, Seattle, LA. But then some markets, have been, it's 1-2%. I'm trying to find Dallas on here. Dallas is about 1% down in rent collections, right? The only positive here is Salt Lake City of all the markets in terms of rent collection by market. And so when you start thinking about, all right, where's the sales volume going? Where's the rent collections going? How's that impacting pricing? You can see the major markets here, the pricing is down significantly. really because the only people selling really are distressed sellers right now. So the pricing has come down significantly, whereas you see sort of your non-major markets has been pretty much flat on the pricing per unit. So collections have come down, right? Rent growth has come down, but cap rates have decreased. And so that has allowed pricing to stay essentially flat. These are never easy charts to look at in terms of pricing, but this puts price per unit on the right-hand side and then rent change on the top half. So really, you want to be in the top right, I would say, in terms of markets. So you have positive rent growth, and your values are going up. So Dallas, Atlanta, Phoenix are doing well in this market. Houston, Austin are still doing well, but then their rents are going down right now. Where you can see in the bottom left, New York City, San Francisco, those are getting hit very hard in terms of rent change and price per unit change right now. And this is what I was talking about when you're looking at individual markets, near the gateway city versus further out in the secondary markets. So it's really like to call it the tale of two markets. Outside of DC, outside of Los Angeles, you can see that these rents are still higher near the gateway cities compared to pre-COVID, but in the city they are declining. So that was a combination of probably 3 or 4 different markets updates from different Freddie, Fannie lenders, and then also Yardi. So I want to put that together and now really talk about how people are still financing deals, right? So we saw the number of sales that were happening and, where the market is right now. So, right now, if you start on the left-hand side, these bank loans, these are really if you're a new investor, if your property is not stabilized, this is where you'll start. And then as you get more and more experience, as you buy larger properties, more stabilized properties, you'll move into Freddie Mac SBL, Freddie Mac Conventional, Fannie Mae. And then if you take on more aggressive, let's say properties that need a little bit more work, more value add in terms of rehab, in terms of lower occupancy at first, then you might have to move into this non-recourse bridge. So this was from, where is the actual debt that is outstanding right now? And you can see that half of the outstanding mortgages right now come from Fannie and Freddie, which is GSEs. And then banks are about 30%, life companies about 10%, and then CMBS about 3%. So, majority that we're going to spend the time on is really Fannie and Freddie and understanding that lending, but then also talk a little bit about what the banks are doing right now. In terms of Fannie and Freddie, their Q2 volume was essentially the same as last year, up a little bit. And that was really probably because of refinances and the lack of other lenders in the market. Q3 was down a little bit. And there's probably a lot of acquisitions here last year compared to this year. So this refinance volume hit a high in Q2, but could not sustain in Q3. Q4 is probably going to be right in that same range as 2019, probably even higher, just because of the number of transactions, number of acquisitions that are trying to close this month and next month. So here's a deal that I want to talk about, sort of comparing Fannie and Freddie. Typical Class B deal in Dallas, 250 units, $26 million purchase price. You really have 2 choices on these deals. You can either go with a Fannie fixed rate quote or a Freddie floater. And so depending on your business plan, we've seen a lot of people move to this Freddie floater. It's a floating rate loan. You have to buy an interest rate cap every 3 years. And then there's a 12-month lockout and only a 1% prepay. And your net worth requirement is usually about half of the loan amount. So that is different than Fannie. Fannie, you're going to be fixed rate. This is what a lot of people use the last probably 3 to 5 years. Fixed rate, no interest rate cap needed, but you typically have what's called yield maintenance. And so we're seeing people take shorter yield maintenance penalties, maybe a 10-year fix, 7-year yield maintenance. Net worth is equal to the loan amount. And what we saw probably the last 2 weeks is Freddie essentially, all loans have to be approved by Freddie. And so that process, the number of deals that went into Freddie the last 2 weeks of October was huge. And they needed all those loans to close at the end of the year. So at the end of October, they said, hey, look, if you don't have are a loan into Freddie, by now you're not closing year end. So a lot of people had to pivot over to Fannie to get those loans closed by the end of this year. In terms of interest rate pricing, interest rate cap pricing right now, we're seeing it's about 22,000 on a strike rate of about 2% on SOFR right now. So it's quoted over SOFR on the Freddie floater. Here's a little bit of a snapshot on sort of what prepayment penalties look like and why people are looking at this Freddie floater. This is on the top is yield maintenance. So if you have yield maintenance, this is the penalty depending on what year you pay it off. And then this is your prepay if you took a Freddie floater. And so you can see that essentially if you hold the deal less than 5 years, you're pretty much better off on the Freddie floater. If you hold it longer, then the Fannie fix works better on that deal. So, and this is another example. We're seeing people who are looking at their existing Fannie Mae debt, and they might be paying 4.5%, 5%, and they can refinance that loan and drop their interest rate by 150, 200 basis points. And so on this particular example, we were looking at a deal. They had owned it for about 3 years. They still have 7 years remaining on the term, and they had a sizable prepay. And they decided, hey, let's see if Freddie can refinance it. It'll drop the loan amount, drop the interest rate, increase the loan amount, but the payment will essentially be the same in terms of interest payment. So the current interest payment was $380, and then the new payment would be $375, and you would return about $2.5 million, which is about 40% of the original capital stack. So this is something to look at as well if you have existing debt. All right. So let's go through. So that was Fannie, Freddie, sort of at a high level. I wanted to go through a couple of examples on the bridge side, on the recourse bank side. So we're still seeing loans done on this. This is not stabilized deals, under 90%, typically under 5 million. People don't really like to sign recourse bank loans that get over 5 million, and you can get non-recourse bridge if it's over 5 million as well. The main thing here is they want local sponsors with a strong secondary source of income. So if you're a doctor, accountant, lawyer, that works well. Deals right now are priced in that 4 to 4.5 range because federal funds have come essentially all the way down. Freddie Mac SBL is perfect, sort of from that million to 7.5 million. These are fixed rate loans, and they have a step down prepayment. So if your loan is under 7.5 million, most of the time you're not going to do that Freddie Conventional. Freddie Conventional really starts at 7.5 or higher, and it's going to be a floating rate on those deals. This one, just remember, every deal must go into Freddie for approval, and then they are focusing on local sponsors, and they want typically about 2 years of experience and 3 properties if you want the max leverage. If you don't have that experience, they might cut you back down to 75 or 70% leverage, depending on the debt service coverage. Freddie Conventional, that's what we talked about. Big thing here, every deal must go into Freddie, and it can take some time for that final approval, about 2 weeks. And they are more conservative on underwriting. And in terms of foreign guarantors, they require them to put up 5% post-close liquidity in a U.S. bank account for the entirety of the loan, which is something that Fannie does not require. So if you are looking at Freddie Conventional, just make sure that all your guarantors are U.S. citizens, or that they might have to put up a large amount of liquidity in a bank account. Like this was a $20 million loan that we were looking at, and so 5% is $1 million in post-close liquidity. So if your foreign guarantor has that, then that's fine. But a lot of times when you're putting these syndication groups together, not one person has that. Usually it's a combination to get to that net worth and liquidity. Reserve requirements are still the same, 12 months P&I on Freddie SBL, and then Freddie Conventional, 9 months of P&I. Big thing here is, remember, assumptions require no reserves if you take no supplemental. Forbearance report, this hasn't changed. The big thing I would say is Freddie does a lot of big loans and a lot of small loans, and a lot of their issues right now are on the small loans. So 76% of the loans in forbearance are on the small loans. A lot of these deals are 50 units, 60 units. So if you lose 2 or 3 tenants, that's a big hit to your cash flow. And most of those are sort of your B and C. And those, as we saw earlier in the slides, the affordability, the tenant base at those properties, typically of, let's say 50 unit deals that are B and C, those tenants are not making $75,000, $80,000 a year. They're making $35,000, $40,000 a year. And so that tenant base has been hit definitely harder. And then they're also seeing a little bit more forbearance requests in student housing and senior housing, just depending on, if that senior housing was impacted by COVID, or even on the student side, if that university is open right now. On Fannie, I would say a lot of people right now are looking at the 10-year fixed, 7-year yield maintenance, or even step down. And then there are a lot of deals available on assumption. So you can get a lower basis, but you will have lower cash on cash because you're paying not only the interest, but then the principal. And so Fannie Mae goes from $1 million up to $100 million. And, right at that $6 million mark is where loans get better in terms of interest rates. So 1 to 6 is a little bit more expensive. At 6 million and higher, it is definitely better. So Fannie Mae is still one of the best options out there for non-recourse financing. Here we look at a couple of different options in terms of, if you went the regular yield maintenance, but then you wanted to go, let's say a 7-year yield maintenance, you're going to pay a higher interest rate. It might be 17 basis points on a 10-year and 32 on a 12-year. And we're still seeing green out there. You probably save about 20 basis points on green if you decide to do Fannie Mae green. Reserves, they haven't changed since the summer. So there's still 12 months of P&I, 6 million and above, 6 million below, 18 months P&I. And they're going to hold these for 9 months, and they're going to test your debt service. And then once your debt service is tested, then if you hit your 125 or 135, depending on what tier you're in, then that allows you to get that money back. And some people are returning that to investors. Some people are using that for CapEx. So I actually thought this was pretty interesting. So I just saw this a couple weeks ago. And at the beginning, Fannie Mae did about 280. This is not updated, but they had about 348 loans as of last count. And you can see that of the 4.3 billion, this 2.5 which is about half, more than half. They're already paying their payments back. So what happened was they basically gave them, let's say, 3 months of forbearance back in March. So if a borrower raised their hand and said, hey, I'm not going to make the payment for 3 months, now they have to essentially make those payments over the next 12 months. So you can see about half of the people, half of the loans out there, they are making their payments back to the lender. But then these loans, active, extended, it's requested, forbearance has expired. These loans here, those are the ones that essentially people said, look, 3 months wasn't long enough. I need another 6 months or 12 months. And in terms of forbearance, so these are the loans that people are still working out right now on the Fannie book. And so, I mean, it's still relatively small. It's about 1% of the population that Fannie has on their books. They do not give the same detail around, student, senior, in terms of that. But you can see that Fannie still has some work to be done. But I mean, this is actually pretty, pretty good news in terms of people just getting back, making their payments versus still being in forbearance. So more than half are coming out of forbearance. This last one that we'll cover is non-recourse bridge. So this is when people, they need higher leverage, and Fannie and Freddie are underwriting the current income. And so the rents are under market or the occupancy is low, then some people will take a non-recourse bridge. And this will allow you to come in and get like 80% leverage. You can do like a 10,000 unit rehab, and your all-in rate's about 5%. If you go under 5 million down to, let's say, $2 million loan, then it becomes a little bit more difficult. There's less bridge lenders in that space. And so your rate is going to go up typically in that 8, 9, 10% range on the non-recourse side. So I'm going to wrap up with a couple of outlook slides, crystal ball slides here for you guys. And, I like to see 2 quarters of positive GDP growth before I really invest in any deals. And so we had 2 negatives. Q3 was positive, obviously, but Q4, I think everyone's looking in that single digit positive. And then if this, let's say, third wave of COVID doesn't happen, then I think everyone's expecting just sort of positive GDP at a smaller number throughout. So this is the prediction. This is coming out of Evercore and Yardi, and I think everything has an asterisk per COVID. So this is what they're expecting right now. And then this is probably the thing that surprised me the most is, historically when you have a recession, the supply of units goes down significantly. So 2011, 2012, you're at 150,000 units delivered nationwide, and then the last in the expansion, everyone starts building, right? So we see a little bit of a flattening here in 17, 18, and then Yardi and they were expecting supply to come down in 2001, 2022. 2021, 2022, but then they've re-updated their forecast. And they're saying, look, we're seeing a lot of people are still building units and putting in a lot of new supply. And so they've re-updated their forecast and they have put it back up to 300,000 units. So it worries me a little bit on the Class A side that the amount of new supply is still coming. So, and then obviously here's the forecast. Most of it's still urban. The suburban's not as bad, and rural definitely is the lowest. So this is where it's coming though. And it's definitely market by market, right? So you see Dallas Fort Worth right at the top in the next 5 years, 100,000 units. Next is DC, then Houston, Austin, Denver. But the more important thing to look as a percentage of supply, right? So Austin, even though it's half of what DFW is, that market is about 20% the size of DFW. So that's about 20% of the existing stock is going to be increased by that amount. Denver is still an 18%. So this number scares me as somebody who lives in Dallas Fort Worth and invests in Dallas Fort Worth, but it is 13%. So divided by 5, it's 2 to 3% per year, which isn't bad. But Austin, Seattle, some of those are pretty big numbers as a percentage of stock. So this is where they're seeing rents and occupancy. The California markets are hit by rents right now. But then, most people see the rent growth in 2021 coming back in a lot of these markets. And occupancy staying pretty stable. So that's all the slides I had for today. If you guys have any questions, definitely put it in the chat. I probably got 50 questions that I pulled out. So I have those questions ready to go, but I'm going to take a little bit of a pause here and just maybe put in the chat if you guys have any questions based on those slides. If not, I'll go through the Q&A that I received beforehand.
Hey, James, this is Malai. Just a quick question on that supply or the financing slide that you had. You said that we're pretty close to 2012 numbers for this year or the next year. Is that right?
The financing slide? What are you talking about? Which one are you talking about?
The number of loans. Yeah, that one.
This one? Okay.
Right. Is it because of the Q1? Oh, I think it's the one before. I forget. But is it because of the Q1? Because the numbers are skewed?
I'm trying to see which slide. So you're talking about the number of loans done?
Yes, the number of loans. You were saying that this year is pretty close to 2012, and the Q1 numbers are pretty high. If we take Q1 out, oh yeah, that one.
Oh, this is sales.
Oh, sales, I see.
Sales, yeah. So yeah, Q1 was about 40 billion, which was in line pretty much with all the previous years. But Q2 is where it essentially shut down. Like nobody launched any new deals in Q2. So that's why it dropped to like 15 billion right here. And then Q3 came back a little bit, but really Q4, I think it's going to be in this, it'll probably jump up here a pretty big number. Because I mean, just the number of deals that we're seeing in our pipeline, it's going to be a pretty big number in Q4. Yep.
I see. That makes sense.
All right. Any other questions? You guys can put in the chat. That will work. All right, let's go through some of these questions that I received earlier. Malcolm asks, when is a community recourse bank still the best option? I would say if you're going to hold a deal short term, let's say 1, 2, 3 years, and then the property doesn't qualify for Fannie or Freddie, that's when you need to use a recourse bank loan. So occupancy under 90%, rehab over 5,000 a door. That's your best option, recourse bank loan, Malcolm. Second question, Brandy asks, what season is multifamily investing in? I think it's a little bit of a tricky season right now because under normal circumstances, you would say, all right, after 2 quarters of negative GDP, and now we're expecting to see 2 positive quarters of GDP. You would think we're coming out of this thing, but I think COVID is the wild card here. And if you're able to mitigate that factor and just underwrite to it, a lot of people are still investing in deals right now. So I'm not saying it's the bottom, but people are proceeding as is and still investing in multifamily. Liz asks how to evaluate syndication loan structure, and I think there's Liz is talking more about if you're a limited partner, how do you underwrite the structure that a general partner is using? I mean, the main thing that I would look at is what is the exit plan? So if you plan on holding the deal for 3 to 5 years and you have a yield maintenance penalty, then you have to either underwrite that penalty or you have to underwrite a higher cap rate. So that would be number one. Number two is if you have let's say floating rate product and you're going to hold the deal longer, how are you mitigating the interest rate risk? So underwriting those 2 options and understanding that is probably the key thing. And I would just make sure that if me as a limited partner, if you are taking if let's say there's a lot of risk in the loan, let's say you're taking a bridge loan that has a 2 or 3 year loan term, then I would just make sure that that is the riskiest type and that you're getting paid for that risk as a limited partner. All right, Claude asks, can you purchase with a previous foreclosure? So you can. Usually they want to see that probably about 5 to 10 years away or in the past. So if you just had a foreclosure in the last 2 or 3 years, probably not the best time to reapply. But if it was 10 years ago, 15, 20 years ago, and then plus you're signing with other people and it is just, one of 5 co-sponsors, then that usually is okay on Fannie and Freddie. John asks, COVID impact on cap rates. I would say COVID impacted interest rates, and interest rates are impacting cap rates right now. So COVID dropped 10-year treasury from, let's say, 1.5 down to 70 basis points and dropped the federal funds rate. And so that allowed interest rates to come down. So that cost of debt has come down, let's say 30% pre-COVID. And that has allowed pricing to stay the same. So even though collections are down, even though expenses are a little bit higher, so your NOI is down, but your cap rates have come down, so pricing is the same. Delphine asks, how do I get an agency loan? So there's essentially 20 banks who are allowed to get agency loans. So Old Capital is a mortgage broker, and so we connect you with the particular lender that applies for those loans. And those people have a license from Fannie and Freddie. And then once you get that agency loan, it takes about 60 days to apply for. So to step back a little bit, the first thing you do is send it to us. We get it sized, figure out what loan product it qualifies for. Then we get a quote from that particular lender. And then that might be a Fannie or Freddie quote. And then once we do that, then you get an actual loan application. And it takes about 60 days from there to go through the underwriting and actually close the loan on an agency loan. Michael asks, where do you learn underwriting? So I learned it actually on the job. When I was at GE, we underwrote everything. We did apartments, office, office, retail, industrial. We did everything. And then now, I mean, there's so much online in terms of podcasts, in terms of videos, and really you have to do opportunity exposure. What Jeremy Roll said at our last conference is you have to start underwriting these deals, make sure you see, where do you see the rent growth? Where do you see the occupancy? How do you underwrite the NOI currently? And that's how you learn it, just by looking at more and more deals and probably working with someone more experienced. Taylor asks, how has COVID changed financial requirements going forward? Really, it's the reserves. So the, Fannie and Freddie, they put in these reserves. At first, it was about 10% of the loan amount. Now it's about 5% of the loan amount that you have to put up. You essentially it's held at the lender for 9 to 12 months, and then it's released back to you as long as you hit your debt service coverage requirements. Phil asks, best deal structure for value add. Depending on the lift, depending on the amount of rehab that you're doing, bridge usually is the best. That is a little bit more risk. Some people would rather take, let's say, a Freddie floater. That way you do not have a balloon payment at the end, but you have to raise more money for the rehab, typically. So one of those two. So probably a floating rate loan with a 1% exit is the best deal or best loan for value add. Richard asks, what other options do I have to raise capital besides from individual investors? Most of the people are doing syndications. The benefit of syndication is that individual investors are putting 50 to 100,000 each, and you as a general partner have control of the deal. Other options that we've seen people do is you can have one person write a check. So it can be a tenant in common, or you can do like a private equity shop. But most of those guys on the private equity side, they want to write, let's say, $5 million checks and higher. So that means if 20% of your stack is $5 million, then you're probably buying a $25 million deal or higher. So most people aren't going to start that way. Usually over time, maybe that will be what they will do as you do more and more deals. Krellin asks, are construction loans available? What are typical terms? Construction loans are available. There's HUD loans available. There's recourse bank loans that are available. But in typical terms right now, I would say are probably in that 60 to 65% range, 2 to 3 years IO, and then it will go to, you'll have to refinance or sell the property at that point. All right, Justin asks, what does qualifying for a loan assumption differ from, let's say, a new loan from a lender's perspective? Loan assumptions, they're going to compare who has the current loan or who's the current owner, and then compare it to you. And it is actually a more difficult process qualifying for a loan assumption because they're going to look at a lot of different things, but the same way in terms of net worth and liquidity that you need is the same. But then they're going to look like, all right, well, how is this person going to come in and change this property, right? So if a property is not doing well, then how are they going to come in and change this property? What's the rehab budget for them? But in terms of net worth and liquidity, it's similar to a new loan. I would say that the fees are higher on a loan assumption because there's a 1% Fannie fee. And then also you have to put up the reserves that the existing borrower has at the lender. So you have to replace all those reserves, the taxes, insurance, replacement reserves. So a lot of times the closing costs are higher on a loan assumption. Brendan asks, how do I acquire a multifamily property on a loan assumption? So similar process, but I would build in probably 60 to 90 days on a loan assumption versus on a new deal, 45 to 60 days. On a loan assumption, you are essentially gonna, you can work through a mortgage broker to help you through the process. But essentially having a good relationship with that lender, you're going to have to work with the exact same Fannie lender who has the current loan on the property. Clara Diana, is it always a balloon payment at the end of the loan term? And can I extend the loan in case the property performance is not doing well? Most deals are 3, 5, 7, 10-year loans. The only product that really is out there, there's a Freddie SBL hybrid product that you have a fixed portion for 5, 7, 10 years. And then they also have a floating portion for additional time, which extends it to a 20-year loan. So that's the only one that I'm available, but it's still a balloon payment. So you can do that loan if the balloon payment scares you, but almost all of them have balloon payments. So I would mitigate the risk by not waiting until the last 3 months. I would start the refinance process early on before that. What is the top consideration for first-time general partners? I would say build your team and get educated, right? So in terms of first-time general partners, you need a team to qualify for your loan. You need a team to find the deal, to raise the equity, because it is very difficult to do on your own. What is the best first deal to make? So if you're a limited partner, you just get started getting in a deal, maybe investing with someone who you would potentially work with on the general partner side. On the general partnership side, I would say buy a stabilized property and get your first deal done, because that first deal is the hardest. Neil asks, how will interest rates and cap rates react? I think interest rates are going to be flat and cap rates are going to be flat in the next 6 to 12 months. Matthew asks, how do I get financing for a $2 million deal? If it's stabilized, Freddie SBL, Fannie will work. If it's not, you're probably looking at a recourse bank loan, Matthew. So I wanted to check and just see if anyone had any questions. I was just going to wrap up with, this is probably the last couple slides here. I actually got a letter today about using Old Capital versus a direct lender. I wish I could read it to you guys, but I'm still checking on it. The big thing I would say is we do all loan types. That's number one. So a lot of these direct lenders, they might have a Fannie license, a Freddie license, or they might just do bridge loans. So we do all loans. We focus on multifamily. We give you a lot of support sort of before the deal, during the deal, after the deal, in terms of education, in terms of working with you, connecting you with vendors, being a second set of eyes, and then highlighting you on our podcasts, at our conference, in our Facebook groups, things like that. And then we charge 1% of the loan amount at close, which is what all the other guys do as well in terms of pricing. So definitely, number one, if you haven't seen a YouTube channel, definitely subscribe to that, like this video, share the video once it gets posted. And then if you need help with any term sheet or you want to review a deal, send me the T12 rent roll OM or the investment package. And then really to get pre-qualified, check out or send me your personal financial statement and we can set up some time to talk. So I'm going to stop the recording there and then we'll jump in and check in with you guys because let me see here. All right.